I'm Selena Wang, in for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, the trade standoff between the U.S. and China intensifies. U.S. tariffs on $34 billion of Chinese imports have gone into effect, followed a few hours later by a statement from Beijing to expect retaliation. Plus, U.S. hiring topped forecasts in June, but unemployment rose from an 18-year low and wage gains unexpectedly slowed. What role do robotics and automation play? We'll talk to one automation startup who just closed a massive funding round. And Sonos files an IPO while the wireless speaker pioneer is taking this route. And is there enough investor interest? But first to our top story. After months of rhetoric, the Trump administration's 25% tariffs on Chinese goods have taken effect. The tariffs hit $34 billion worth of imports, including a focus on high-tech industries in an effort to protect American IP and stem China's attempts to become the global leader in tech. China immediately responded with tariffs on $34 billion of U.S. goods, including automobiles and soybeans. And after all of this, President Trump escalated, threatening to impose tariffs on every Chinese import into America. This provoked a variety of response from guests on Bloomberg TV. Take a listen.
There isn't clear evidence in the data that the anxiety over trade is being harmful to the industries that we would most watch for harm in. And I think that that's probably because these people all understand that the president's driving the world towards a better equilibrium.
We've heard from a lot of companies that are thinking that they might shift around where production happens to try to ensure that they can still have a low price. We have some companies who feel like that is such a capital expenditure to figure out how to change their supply chains that they might try to ride it out for a while.
If you have a hammer, you can either use it to nail nails on the wall or you can hit yourself in the face with it. And I think that Mr. Trump should stop, hitting the U.S. in the face with these tariffs, because I think it's bad for everybody. It shifts the demand curve to the left, and it's a lose-lose situation.
We need to get back to real negotiations about the real issues, such as intellectual property and opening some markets, not just sparring with each other and competitive tariff increases.
This could well be what I call the Reagan moment, where simply China cannot keep up with the U.S., and suddenly you have serious discussions on intellectual property, on technology transfers, and on non-tariff barriers. So counter a little bit the view that we may be more towards the end of the process than the beginning of the process.
There's perhaps a silver lining here in that this war, this skirmish, leads to a better global trade system.
Let's go to D.C. for the latest, where Scott Kennedy, a director at the Center for Strategic and International Studies, and Bloomberg trade reporter Jenny Leonard are standing by. Jenny, I want to start out with you. Trump is now threatening to impose tariffs on pretty much every single good that China imports into the U.S. What's the probability that that will occur versus a cooling down after this first round?
Well, I would say you can never rule out anything with this administration. So far, it is a threat. I would also say that right now, what the tariffs are imposed on is not consumer goods, so it will not directly impact him or his political chances, his party's chances in the midterms. If you do impose tariffs on all Chinese goods, that will impact consumers, and that might actually, impact the elections in November.
Now, Scott, it's no accident that China is targeting America's heartlands with its tariffs, many areas which backed Trump in the 2016 elections. Yet it's also a boon to his political base to be able to say that he's being tough on China. So how much economic and political fallout has to occur before he backs down, or maybe China blinks first?
I think for the president to back down, he's going to have to start seeing poll numbers shift significantly in terms of his own approval rating and the chances of House and Senate candidates in November. And at this level of tariff whacking back and forth, that's not going to happen. The question is, as Jenny was alluding to, it's not going to be the direct hit from these tariffs. It's going to be whether they are combined with pulling out of NAFTA, tariffs on autos, changes in the stock market. Those are the types of things that could change support for him and make him look to want to talk to the Chinese. The other would be something that happens on the Korean Peninsula, because obviously that's a high priority for him as well. So if the poll numbers change or the outlook on the Korean Peninsula changes, those are the two kinds of things that might make him want to come back to the negotiating table in a real way.
Now, Scott, many have argued that the better way to get China to the negotiating table is to work with allies and have a sort of coordinated response. Is that option still on the table, given how much this administration has alienated its allies?
I think if President Trump were to look to his right and look to his left, he's not going to find a lot of friends there who are going to be willing to put tariffs on China themselves. There's certainly a lot of support for the idea that China's played unfair and that it needs to change its policies. But he's basically already let that opportunity pass to form a common front against China. And it's also not clear what he's asking, what his real demands are, which is, our friends in Europe and Asia, their demands are about Chinese industrial policy, not about the trade balance. And so until he radically tries to improve relationships with our allies and friends in the Pacific and in Europe and clarifies what he wants, he'll be standing there alone vis-a-vis the Chinese. And I would agree with you that that makes it much harder to get the kind of deal that would support America's national interests.
Now, Jenny, does any of this even put a dent in China's Made in 2025 plan? It seems that many of the sectors that the U.S. is concerned about actually have pretty low exposure to foreign revenue.
Right. So it seems like China's Made in China 2025 plan is plowing ahead. The Chinese have also said in the statement yesterday when they announced retaliation on $34 billion worth of U.S. goods that any sector that might be hit by the U.S. tariffs will get government assistance. So China obviously has all of the help in the working that whoever gets hit by U.S. tariffs is going to be compensated for. And so that's what we're seeing. And the U.S. looking for changes to Made in China 2025 doesn't seem like, with what the U.S. is pursuing right now, they will actually get there.
Scott, the Trump administration would argue that this is the only way to pressure China into stopping their unfair trade practices, IP theft. Do you think there are better options, and do these tariffs or the CFIUS reforms accomplish any of that?
I think unilateral pressure, reforms for screening of imports or investment for national security can be part of a solution, but they're just part of a solution. You need a really all of the above strategy, collaborating with allies, trans-Pacific partnership, investing more in high-tech and education and healthcare at home, revising the global rules related to high-tech, to data. The president has focused on this one aspect of dealing with the problem, but it's just, you don't build a house only with a hammer. You're going to need a lot of other tools to fix this thing and to get the job done.
A big focus has also been reforming the Committee on Foreign Investments in the U.S. Does the U.S. government actually have the infrastructure to fundamentally properly screen all of these investments and scrutinize them?
So what's happening right now in the U.S. Congress is that the legislation is being reformed, and part of that is also having more personnel, having more funding. That is making its way through the Congress. When the Trump administration endorsed that plan as the investment restrictions that they're putting on China and investments from other countries, they endorsed it and said, Congress, I need you to pass this. We need you to move quickly. So this is what's happening on the Hill right now. It's obviously a recess week, so we'll see that picking up in the next week and moving forward. And that's what's going to happen. What's also in this is more personnel and more funding. So that's definitely needed.
All right, Scott Kennedy of the Center of International and Strategic Studies and Bloomberg's Jenny Leonard, thank you both for joining. It looks like slowing demand for smartphones might be catching up with Samsung. The Galaxy phone maker's operating income rose to $13 billion, falling short of analyst estimates during its second quarter. Samsung's chip manufacturing business, which remains its largest profit maker, may end up benefiting from U.S. tariffs on China. The South Korean chips could be an attractive alternative for Chinese companies instead of U.S. ones. Coming up, U.S. unemployment ticks up in June while wages stay under pressure. Are bots to blame? We'll talk to the CEO of Automation Anywhere, which is helping to lead the robot revolution in the workforce. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg Radio app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. The unemployment rate climbed to 4% in the U.S. in June, while wage gains unexpectedly slowed. As economists parse the labor picture, one factor on everyone's mind is the impact of automation. Enter Automation Anywhere, an enterprise software company that's bringing more bots to the workforce. Just this week, the company closed a $250 million Series A funding round led by Goldman Sachs. And Mihir Shulka, Automation Anywhere co-founder and CEO, joins us now. Mihir, more than 1,000 organizations are using your technology, including Google, General Motors, and MasterCard. How are they using your tech?
It's being used across, as you said, vertically, virtually every industry. They are taking various kinds of manual business processes that couldn't be automated with traditional technology, and they are using our platform, bots, to automate all those business processes. So
are your customers actually replacing any of their workforce as a result of using Automation Anywhere?
I think the way to think about this is that this is not a replacement story, it is an augmentation story. So where human and bots are working side by side, doing what bots do best and what people do best. Almost think of it like a computer. For all of us, when computers were first introduced, we had the same worries. But today, if I take away your computer, most people would say, how do you expect me to get my job done? That's the same story we are hearing again from our customers, where employees, if they start using bots, they cannot go back to doing it the old-fashioned way.
So right now, it's a beautiful picture of bots and humans working lovely side by side.
Yes.
But at one point, will humans be stripped out of the picture and these automated platforms can just run on their own?
Not at all. There are lots of, I think there are fears that are a little overblown on this, and there are lots of stories written on this subject. But I might have something that is slightly better, which is data. So because we are in the middle of 1,100 this large-scale projects, and what you see is exactly opposite. Companies that use bots receive 3 times more job applicants. And because you want to work on the most cutting-edge stuff, you want to take the robot out of your work and make work more human, and employees love that. On Fridays, they have bot parties where there are 40 or 50 new bots are being born. They cut a cake, they have names for it. It's an electrifying atmosphere. So the reality couldn't have been farther from the fears.
I don't think I've heard an analogy of bots being used in that way before. So now you have countries like Japan that are relying on automation more and more as their workforce ages. Are you seeing the United States moving in that direction?
Absolutely. Along with the United States, this is happening across the entire country. We have customers in over 90 countries. What is happening is, for most of us, we may not realize, but overall our planet is aging and the working age population is on a sharp decline. So without the bots, there is no way to keep the growth rate going. So very soon we will be using bots in every aspect of our life.
And now you're operating in more than 90 countries. What is your operation like in India? That's a country that's a huge outsourcing hub for many of the big tech companies.
It's being widely adopted there. There are lots of processes that are happening in India, Philippines, and other parts of the world. Organizations there are very actively adopting usage of the bot to accelerate the business processing.
Now, bots can be good. Like your company, they can also be bad. And a lot of the social media platforms have been dealing with these very sophisticated bots that are iterating faster to spread spam and manipulation faster than they can deal with it. So how do companies like that make sure they're staying ahead?
What we are seeing is that, and you pointed out very well, there are good guys bots and there are bad guys bots. So we are the good guys bots. You hear about the bad guys bot. Just if you go back to when the software came in, we had the problem of viruses. How did we deal with it? We wrote another program to stop all the viruses. Similarly, when the bad guys bots attack the infrastructure, many customers are using our bots now to counter it. And that's the way to solve it.
Are you working with any of the big social media platforms like Google, Facebook, Twitter?
We are today working with many banking, financial services, and insurance company. This problem, although we hear more about social media platforms, this problem is faced by virtually every company today. So it's being used heavily in other industries today.
Now, Goldman is one of your lead backers. Are they a customer? Why did they invest in you?
They are our customers. I think being a customer, they probably saw the impact this can bring to them and other banking and financial services insurance company, not to mention they have an exposure to a much wider range of verticals. So they could clearly see that this is the technology of the future that everybody will adopt.
And your company is actually more than a decade old, and you were valued at almost $2 billion in this recent fundraising round. Is an IPO on the near horizon?
You never know. You always, we like to focus on building a great company and then take it year at a time.
All right, Amir Shulka, thanks so much for stopping by.
My pleasure.
Now coming up, the scandals at Facebook are starting to stack up. Will it start to have an impact on user growth? We discuss. This is Bloomberg. The pace of controversies at Facebook are not slowing down. Just this week, the social media giant apologized for taking down a post containing excerpts of the Declaration of Independence, explaining that it was mistakenly flagged as hate speech. Meanwhile, the stock hit a new record high on Friday, and BTIG recently raised the price target on the stock, adding that Facebook is a must-have utility for staying connected. For more, let's bring in Techonomy CEO David Kirkpatrick in New York. David, if Facebook is in fact a must-have utility, should it be regulated like one?
Well, whether it should or shouldn't, the answer is it will be. I mean, I basically think it should. I think anything that has that degree of influence on the world in literally every country really has to have some government oversight. There's too many consequences of the way Facebook operates in our society not to have government looking over their shoulder, in my opinion.
And David, that 747-page document Facebook recently released to Congress had a slew of new details about dozens of hardware and software partnerships, including ones with Huawei, Alibaba, Amazon, Apple. What more do we learn about the extent of those relationships, and were those dealings common practice or something more?
Well, I think to some extent they are common practice, that if you're going to have the kind of service Facebook has, and you're going to make it work really efficiently and smoothly on a wide range of devices, you need some version of those kinds of partnerships. The problem is Facebook's candor. And I think specifically the problem is some of the things that Zuckerberg said or denied in his congressional testimony that turn out, in effect, not to have been true. I mean, what really that document showed was that whereas he said they stopped the data sharing with apps in 2015, in reality they extended a number of those apps partnerships for much longer than he said in his testimony. And it's a little fuzzy to me when they actually ended all of them, because there's so many caveats and qualifications in there. Second of all, they announced something that had not been asked about during the hearings and that most of us really had never focused on, the issue that you mentioned before, which are these partnerships with hardware companies. Now, it may be that those are legitimate, but the existence of those partnerships, in effect, contradicts things Zuckerberg said in the hearings about how they are not any longer sharing your personal data with other companies. So they have a semantic excuse that these are not actually, app partners. They're actually, I forget the terminology, but they're more or less extensions of Facebook in the way they like to think of it. But that's not the way the users think of it. And it's very contrasting to some of their promises. And even the FTC, which is still investigating with Facebook based on an earlier complaint, may find that this is a violation of what Facebook promised to it. So sorry for the long answer, but it's a complicated issue.
Right. Well, clearly it raises tons of questions as well as answers. And did this give any visibility into why they didn't investigate apps like Alexander Kogan's when they found out that it had violated its rules?
That's a really critical question that they haven't really addressed. I think they just sort of bypass that sort of, rationale issue. They don't explain their thinking. They just say, well, we didn't do it. We should have done it. We're sorry. We made a mistake. It's a really good question. We know that the whole Kogan thing, which led to the Cambridge Analytica thing, which led in part to potential manipulation in the presidential election, was a result of their not correctly giving oversight to that one app. But now they're saying there were many, many other apps that had that same kind of data, and they haven't explained why they didn't tell users about that or why they didn't take action earlier. There are plenty of unanswered questions that deserve answers, and I think probably Congress and others will demand answers for.
David, you've been covering Facebook since its very early days. You even built a personal relationship with Mark Zuckerberg. Fundamentally, though, can this company both optimize for profits and the well-being of its users?
That's a really good question, and I don't think he's that eager to talk to me right now because I've been criticizing him a lot lately. I think the key question is, their stock is going up. Somebody put a $275 target on it today. They're making unbelievable profits, 43% net margins, which is unheard of in any business. And yet they have all these bizarre impacts on society, and they claim, and Zuckerberg keeps claiming, the primary goal is creating global community. I don't think it's really possible to have as your primary goal to create global community and to retain your 43% net margins. So that really is where the conflict lies that has not been addressed.
And David, Facebook recently, in a quiet reorganization, took one of its highest-ranking executives, David Marcus, and put him in charge of this blockchain project. What do we know about it, and what does that signal?
Well, that's a really interesting issue. David Marcus is one of the executives that everyone has to be most interested in because he's one of the most experienced executives at Facebook. He had previously been CEO of PayPal. I don't think they have any other executive who was CEO of a company of that scale prior to joining Facebook. So he was previously running Facebook Messenger and caused it to grow spectacularly over the last several years so that it's now in the 1.2 billion, 1.3 billion user range. But they took him off that job and put him on this mysterious blockchain project, which I think is indicative of the fact that they are worried that the use of personal data could become more and more under threat. And there are many people who believe that blockchain is a potential tool to help users protect their own data. And a lot of startups are doing things aiming to build systems using blockchain for that exact purpose. So you could see what Marcus is doing as a hedging strategy.
All right, David Kirkpatrick, CEO at Techonomy, you're sticking with us. Coming up, the effect of trade tensions on technology. How will the escalating dispute between Washington and Beijing impact the respective tech sectors? We discuss next. This is Bloomberg. This is Bloomberg Technology. I'm Selena Wang here in San Francisco. Now back to our top story. The escalating trade tension between Washington and Beijing, and in the crosshairs, the tech industry. Since 2002, the U.S. has seen a 600% increase in the amount of advanced technology, information, and communications equipment it imports from China. And when China imports from the U.S., it leans heavily on the aerospace industry, with electronics coming in second at 17%. For a deeper look into the tech effect of this trade dispute, I'd like to welcome back Techonomy CEO David Kirkpatrick in New York, and in the studio with me, Bloomberg's technology executive editor Tom Giles. Tom, I want to kick it off with you. What are the broader effects here of this on the technology industry? Which sectors are getting hit hardest? There's obviously a lot of knock-on effects as well.
Yeah, well, there's a couple. The first one to talk about is the chip industry. They seem to be caught up in this in the biggest, most dramatic way. And what I mean by that is it's not that there's direct tariffs on the chips themselves. It's that there's a lot of big chip makers that are getting caught up in the tension and being used as pawns, whether it's a company like ZTE. This is an electronics maker, and the impact for them is the U.S. going to ban purchases of ZTE equipment? There's a long-running grudge against ZTE for allegedly selling products to companies, to countries like Iran, North Korea, and then lying about it. There's Qualcomm NXP. Qualcomm wants to buy this Dutch chip maker, NXP. It has to get approval from that in China. China is holding up approval of this. And the concern is that is actually part of the trade war.
Not even to mention Micron as well, which is also being hit.
Exactly.
And David, speaking of ZTE, they recently just got approval to resume some business activities in the U.S. This was seen as a bargaining chip in the trade war, but now they're getting some more lax policies, and we haven't seen any trade war averted. So what's going on here?
Well, I do think that when Trump banned exports of U.S. components to ZTE a month or so ago, I think it was sort of a strategic negotiating ploy. It was ostensibly in order to punish them for having traded with Iran in violation of the embargo, which they probably did do. But I think the point of it from Trump's perspective was to demonstrate to China how devastating it could be if the U.S. cut off the flow of key technologies to Chinese companies that, like in this case, are national champions. The fact that ZTE almost seemed to be starting to shut down more or less immediately as soon as that threat was made was very significant. That's now been kind of relatively modestly solved, and they're back to shipping stuff into the U.S. and accepting American goods in their products. So I think it was a way of just demonstrating what we could do.
And now the USTR has insisted that these tariffs don't impact the U.S. consumer, but there are some hardware companies caught in the fray, right? I mean, Flexport had the study about electric bikes being caught up in this.
Yeah, so in a couple of different ways. There are these small components, things like capacitors that store electronic charges. If you're a small company and you need these components from China, you're going to be affected, and you don't have the flexibility. Some larger companies, let's just say Apple, for example, they've got alternatives, or a little increase or a big increase in some small parts doesn't make as big of a difference to them. But it's small electronics makers, startups, that could be affected most. And then we're going to see potentially a second wave of tariffs, and that could be on finished goods. That could be on things like scooters, for example, which we've seen flooding the streets of San Francisco and LA and some of these other cities. And if you see a tariff on that, some of these startups that are gaining a lot of momentum right now could really lose steam.
Right. And David, in terms of the larger companies, what's at risk here for Apple, which is already operating in China and keen to expand, as well as Google and Facebook that want to operate there, but whose core businesses are currently blocked?
Well, just think of how many products most of us receive that are quote unquote designed in California, made in China. It's a lot. If Trump really were to follow through on his threat to more or less put tariffs on everything that China's shipping into the U.S., that would include a lot of iPhones, because that's one of the biggest things that comes from China here. Apple has got to be very nervous watching this whole dispute unfold, because they ship a lot of stuff over there in order to put it into the iPhones that are finished in their assembly there and then shipped back all over the world out of China. It's very precarious for them. They could be seriously affected. I don't think that Trump, though, would take the risk of denying iPhones to the American people, and Apple computers and all the other things, AirPods, and, just name the things that you get from China. There are a lot. So it's a very interesting moment we're in. I think there really is good reason to put China on notice that some of the things they've been doing are inappropriate. But it's a pretty complex issue to figure out exactly how to play those levers without hurting a lot of people on the edge.
And David, I want to get your take on how effective you think China's Made in 2025 plan is anyways. I mean, on one hand, these subsidies could be propping up mediocre companies and pushing out the truly innovative ones.
Well, I think the Made in China 2025 plan, which is basically aiming for China to effectively dominate every major category of technology, has enormous potential for them, and they are moving very steadily on the path toward achieving a lot of those things. Look what they've done, for example, with high-speed rail. They They already dominate the world in that. Could they become the same kind of global leader in autonomous vehicles, electric vehicles? They already have a much bigger ride-hailing business than we do. These are all targets for them. So I think they could really hurt the rest of the world if they're allowed to continue to do all that. And the reason that it's of worry is that many of the ways they've been getting those technologies have been inappropriate through industrial espionage, etc. Now, that's not the only thing they do. They also have tremendously high-quality local technology development. But I think it is appropriate for us to put the brakes on where appropriate so that when they go toward this aim of dominating, they're not doing it unfairly.
All right, Economy CEO David Kirkpatrick and Bloomberg's Tom Giles, thank you for both joining.
Thanks.
Despite the escalating trade conflict between Washington and Beijing, one company is unfazed. Byton, a Chinese electric vehicle maker, is continuing its plans to enter the U.S. market. The startup is looking to sell its $45,000 electric SUV stateside in 2020. CEO Karsten Brightfield spoke with Bloomberg's Tom McKenzie in Beijing about why he's not afraid of trade tensions.
So if you look at Byton, you will find Byton is a global company. It's a global product, a global team using global technology. But Byton is rooted in China. Supply chain is to more than 99% in China, and we're producing in China. So we believe in globalization. We believe in global business. Over time, you might see frictions in trade relationships between countries. This is unavoidable. But on the bigger picture, from our understanding, this will not be an issue for us.
So the fact that so much of the business and so much of the supply chain, as you say, more than 99% is based here in China, that isolates you to some degree?
No, I wouldn't say it isolates us. I just said we are a global product, a global brand, and a global team. So we understand the markets worldwide. We have access to technologies we need worldwide, and we are able to supply our product out of China, out of Nanjing to the world.
And you were considering opening a factory in the US. That was part of the discussion, I know. Is that now off the table as a result of what's going on between Beijing and Washington?
Our plan for now is to complete our plant in Nanjing, to bring the product to production. We will start in the Chinese market by end of next year, which, by the way, is not only the most important, but the biggest market for us. And then we are going to the US in 2020 and in Europe the second half of 2020. Whatever future implications are, we will take into considerations, and whenever we would have to react on it, even from a production side, we are prepared to do so.
Do you get any sense that your investments in the R&D center, for example, in the US, that they could be prohibited as a result of these moves in Washington to curtail Chinese investment in the US?
I didn't get any indication in this area, and I'm not so much afraid of it because, as I said, I believe in global economy, I believe in global teams and in global products. And this is true, by the way, for every company worldwide, not only for the Chinese ones. So we will have to find a solution, and the nations will have to find a solution to keep that going.
So it sounds like, to be clear, you haven't changed your plan, no significant changes to your strategy as a result of these trade tensions?
Our strategy is still exactly the same.
Do you get any sense that the reform moves that we've seen here in China around the auto sector may be changed, adapted or delayed as a result of these trade tensions?
I don't see this for now. I think there are no indications or evidence towards this direction. And again, I'm not, from a Byton perspective, I'm not worrying too much about it. We are here. This is our market. We are producing here. And by the way, we have a lot of R&D, local R&D here as well. So for us, we are looking very confident to our future.
Very recent news that China is going to be cutting electric vehicle subsidies again or further. How does that change the competitive landscape?
This is interesting because I all the time I never have been a fan of subsidies, to be honest, because subsidies they can initiate new technologies, they can open up market segments, but at the end of the day, the product and the business model has to convince the people by itself. So Byton's business model doesn't rely on subsidies. It has to be stable by itself. And you will only be successful in this market if you have the right products which can compete in the market with other products, and this is what Byton is heading for.
That was Byton CEO Karsten Brightfield speaking to Bloomberg's Tom McKenzie. Coming up, taking the Hyperloop global. We speak to Virgin Hyperloop One's co-founder about the future of high-speed transport. This is Bloomberg. It's a concept ripped from the pages of science fiction, a new form of transportation relying on vehicles moving at outrageously high speeds through low-pressure tubes. Dubbed the Hyperloop, Elon Musk shared a white paper on this transformative concept back in 2013, and people and businesses started talking. 5 years on, only one company has tested that vision at scale, and that company is Virgin Hyperloop One. But how far off are we from turning a test into reality? Joining us to discuss is Virgin Hyperloop One co-founder Josh Geigel in Los Angeles. Josh, you recently met with European regulators. You've met with many regulators around the world. There's obviously a lot of hype and excitement about Hyperloop, but what's the #1 concern regulators have when you talk to them?
I think the #1 concern has always been this doesn't exist yet, and everyone's used to dealing with rail, boats, planes, trains, and everything from that standpoint. And they're trying to think of us in that context. And one of the things that is, we're not any of those particular modes of transportation. We're a new mode. So we can draw from the best of that. We can draw from autonomous vehicles, platooning or convoying trucks. But we need to be regulated as our own entity because it's really where the power is, because we can create a brand new experience that's based on the technology that we're building.
And your company also recently announced intent to build a Hyperloop between Pune and Mumbai in India. What would be the biggest technical hurdle to building a Hyperloop around that route? And when would an operational demonstration track be put in place?
So we're targeting construction to begin really over the next couple years, and then passengers operational in the mid-2020s. Again, one of the big things there is the regulation side of the fence. And the things that about that route that are really exciting, there's over 100 million people, almost like 150 million people that travel that route every single year. And a number of our employees actually grew up in that particular area, and so being able to see their parents every day and taking, instead of a 2.5 or 3 hour train ride or car ride on a good day, you're dropping that down to 20 or 25 minutes. And then from that standpoint, you're really able to completely revolutionize how people actually live and work in those two cities, which is really, really exciting. And from a challenge standpoint, the biggest thing is there's a hill about halfway between the two, a couple 100-meter high. And for us, our technology can easily deal with that. But right now, if you look, there's a ton of switchbacks. It's really slow for the road that actually goes on that spot. So it's pretty exciting that our technology could actually replace that and make it even better.
Now, even in this nascent industry, you have competition from Elon Musk's Boring Company, Hyperloop Transportation Technologies. How do the approaches differ, and what are the advantages to each, not just the advantage to your company?
That's a good one. I think for us, Elon is focusing on intra-city transport, so within a city itself. So if you look at what he's doing and the Boring Company is doing in Chicago, they're really trying to connect a short distance between the two airports, fully tunneled. And then basically leveraging the technology he already has with Tesla, with the electric vehicles, to put large buses inside of a tube and transport people that way. For ourselves, one of the advantages that we have is a big, large scale. We've got an organization. We've had a significant amount of funding, so we've been able to build the technology. And the one thing that you will do is you will ride this. We will ride this. My kids will ride this. Grandmas will ride this. And for us, it's a huge thing to be able to test it. And so being able to have everyone in one spot, building, testing, learning, and then iterating is really important. And one of the other companies believes in a crowdsourced model, which I think is it's an interesting way to do a number of different developments. Like if you look at what software is doing with the open source community and everything, it's very interesting. I do think that one's a little bit challenging to actually build hardware with, though.
Now, Bloomberg's reported that you've replaced 3 board members. A 4th one was charged abroad, and your co-founder also recently stepped down. How do you explain all of this?
Well, it keeps things exciting, to say the least. But for us, one of the things that's been really important is we've got different levels of funding through the company and throughout time. And as those funding comes in, just like you've seen with boards of other companies, that ends up changing the makeup of the board. So 2 of the members that moved off of the board are actually still advisors with the company as part of the fundraising that we did in the fall of last year. Mr. Makhmoudov, who's had some issues in Russia, stepped down from the board in May. And then Shervin Pishavar, the former co-founder, basically ended up leaving the board at the end of last year. So we've really come back. Richard Branson has stepped up as the chairman of our board. We've moved into a new process of actually creating a operational. We're trying to commercialize this technology. We're done building prototypes. We're actually building big hardware now. And for us, it's really important to have someone who's done that before with Virgin Trains, Virgin Planes, Virgin Australia, Virgin America, Atlantic. All of those things are really providing quite a bit of value to us as an organization as we move forward.
And Josh, one of your former board members controlled Caspian Ventures. Are they still a major backer of the company? Have they sold any shares?
No, so they're still a major backer of the company. They, as I mentioned before, Mr. Makhmoudov stepped down in May because of the issues that were going on in Russia. They still have their shares. They're one of the earliest investors, and they still have a board seat in our company right now.
And Musk's Boring Company is also working on a route in Chicago. They're saying that they can do it all on their own without any government funding. Is there a scenario where that would be possible for you, or some sort of public-private partnership? Is that the better route?
It all comes down to ridership, and the more people that can ride a Hyperloop, the easier it is to get private financing for that. So one of the big attractive things in India is the amount of riders that are on that route. And if you look at India, there's something like 7,000 or 8,000 kilometers, 500 or 5,000 miles of Hyperloop that could be built in India. And there's so many riders, there's so many people moving into cities there that you'll be able to pay for most of those projects, through private financing because the returns look really good. And so as long as you have a significant amount of riders, and this isn't an insane amount, it's just a reasonable amount. So think, 10,000 passengers per hour, which is normal for high-speed rails in Europe, that you can easily make a Hyperloop case with private financing, public-private partnerships is going to be a big part of our success. And then ultimately it comes down to the government paving the way for a regulatory aspect and the certification of the route within country.
Well, I hope it's not too far off in the future when I can ride in a Hyperloop myself. Thank you, Virgin Hyperloop One co-founder and CTO Josh Geigel. Now coming up, Sonos has built a strong following of fans with its high-end wireless speakers, but can the company handle the pressure of public markets? We'll discuss. This is Bloomberg. It may not be a blockbuster IPO, but Sonos' public offering could gain a lot of attention in the investing world. The wireless speaker maker has filed for a public offering, reportedly seeking a valuation of up to $3 billion. Sonos is a pioneer in the market for internet-connected speakers, but is facing stiff competition from Apple and others. For more, let's bring in Bloomberg News IPO and deals reporter Alex Barinka. So what interest is there from institutional investors in a company like this? I mean, Sonos is a hardware maker. They have huge competition. That's a tough position to be in.
It's an interesting position to be in, but the thing that they have going for them when you do look at the competitive landscape is this is the only pure play bet that will be out there on the audio speaker industry. Whether or not that'll resonate with investors is the question we'll have to see as they kind of continue inching forward in this IPO process. You'll remember today is just the public filing. They haven't set public terms yet. They're still kind of futzing with that valuation there. We've reported a range of $2.5 billion to $3 billion market value. So as the IPO actually starts to get closer, you'll start to see what kind of premium they expect to put on this company. When I dig down into the S1, some of the things that jumped out at me is they are inching toward profitability, about $990 million in revenue last year and a $14 million loss. So close there, especially for a hardware maker. That margin will be important. And, they'll continue leaning on the fact that they sell expensive speakers and they have that kind of margin play there. The other thing that I thought was so important about this S1 is it comes at an interesting time time for the trade discussion. Sonos did flag in its risk factor something that I thought was very unique, the fact that the Trump back and forth with China right now could actually have an impact on the valuation of this company and its financials going
Right,
forward.
I noticed that in the S1 it says any more tariffs placed or related countermeasures could impact the revenue and results of our operations materially. Do you think that will actually impact its valuation? I mean, we still have to see how it plays out, though.
We have to see how it plays out. You saw President Trump today basically threatening to put tariffs on all Chinese goods. Sonos did flag the steel and aluminum tariffs as the existing ideas that might actually impact the cost of manufacturing, a cost that they said they might have to pass through to customers if this still stays. The one thing that is clear is that these political discussions seem to be moving very quickly, so something could change, but I can guarantee you when this company hits the roadshow, whether or not this tariff discussion has a meaningful impact on the bottom line will be a question that investors will have for Sonos and their management.
All right, now lastly, there's no shortage of private financing. Why are they choosing to IPO at this time period?
So remember, Sonos is backed by a couple of folks like KKR, a private equity firm. These folks who are in on these companies do need to see an out sometime. Yes, the private money is fun and it's been there and it's nice to have it out of the public eye, but eventually investors need to show their investors returns as well.
All right, thank you, Bloomberg's Alex Barinka. That does it for this edition of Bloomberg Technology. On Monday, we'll have full coverage of Xiaomi's IPO in Hong Kong with analysis and reaction to one of the biggest technology public debuts in the region in years. That's all for Bloomberg. This is Bloomberg Technology.